Welcome to It's Your Dime, a straight talk interview series presented by SchiffGold. I'm your host, Mike Meharry. In this episode, I'll be talking to Peter Schmidt, creator of the 90tours.com website. In this episode, Peter and I talk about 50 dunces who played a role in the 2008 financial crisis, how the mainstream narrative of the 2008 crash is all wrong, why understanding what happened in 2008 matters, how the Fed is likely set us up for another crisis, and where gold investing fits into the equation. Welcome to It's Your Dime. I'm here today with Peter Schmidt, and I think you're going to find this a very interesting interview. Peter runs a website called the 90tours.com, and we'll get into what all of that means here in just a moment. Peter's background is actually in the petrochemical, oil, and energy field. He's an engineer by trade and also an Air Force veteran. Peter, welcome to the show.
Thanks. It's great to be here.
Absolutely thrilled to have you on. I'm very fascinated with your website, 90tours.com. But before we get into what you're doing specifically, why don't you just give us a little bit of your background? You're, like I said, off the top, you're an engineer by trade. How did you get interested in economics and monetary policy and these types of things?
Well, certainly I, for lack of a better term, I probably stumbled onto some of Peter Schiff's podcasts and the Schiff radio network. And I was immediately attracted to, even though I'm an engineer, economics really works based on logic and not math, because you're dealing with people and not machines, and people act differently. And that's what struck me about Peter when he spoke about economics. It was always concepts, and they were logical concepts. And then so much of what you hear from the Federal Reserve and these PhD economists it's all math and all these formulas. And, I'm familiar enough with formulas to know that, formulas, they have very limited windows where they can be applied successfully in work, and in economics, there's just too many variables because you're dealing with people that I think a lot of those formulas start to break down. And then certainly when you look at the tech bubble and the housing bubble, which no one saw, it's like, well, their model has to be wrong, and so it was from that I really started to look into it and try to figure out as best I could what was going on.
Yeah, that makes total sense. So the whole idea of human action, kind of going back to Mises and the Austrian School of Economics, as opposed to some of the more mathematical and formulaic. Like you said, those things have their place, but they certainly break down because we're human beings, and human beings act differently and have different incentives and motivations. And so, yeah, what you're saying absolutely makes sense. And it's interesting, as kind of coming from somebody who's a numbers guy and a formulas guy, that you kind of see the weakness in in that template, especially in terms of its application to economics. So you started this website, and I encourage everybody to check it out. It's the 90tours.com. So it's THE, the number 92, and then ERS.com. And you've got on there the 50 villains from the financial crisis. And I love this whole concept, but I'm fascinated by the name. And you explained it on the website, but I think it would be interesting for the listeners if you could just kind of give an idea. How did you come up with the name, and what do you mean by the 90 tours?
Okay, the term, the 92 from the 90 tours, comes from the fact that when Harvard got rid of the dean's list, and Harvard is not unique among the Ivy League schools, none of them have a dean's list anymore. Well, when Harvard got rid of it, 92% of their students were on the dean's list. And that struck me as kind of odd, especially as a mechanical engineer who worked so hard to get grades. And, I wasn't anywhere near the dean's list in my school. And, so that was the first thing. And then, the number one major at Harvard or Princeton or Yale or any of those schools, it's always economics. And, all those economics majors, the vast majority of them go to work on Wall Street. So then, to me, there was a huge paradox between, the accolades all these people received in college, where they were on the dean's list, and then what they did when they got on Wall Street and basically brought the country to its knees. So, and it's not just that paradox, but like on the website, what I say is the real root cause of the financial crisis. It's really a human factor, and it's just I guess it's really arrogance that these people have to make these huge decisions, and think that they're actually in a position to control some of these things, like the Federal Reserve, to think that they can just manipulate the interest rate and get a desired outcome. It's a fantasy, and it's really rooted in just the wrong mental makeup. I mean, I think if you just think rationally, the notion of 6 or 8 people on the FOMC, controlling the economy to some desired outcome, it's crazy. It's absolutely crazy.
Yeah, absolutely. Would it be fair to say that some of these guys suffer from a little bit of hubris?
Yeah, and I mean
There.
that's really it. That's really I guess that's probably really better than arrogance. It's just hubris, just like the tragic heroes that we all read about in high school. They're always undone by their hubris.
I like that word a lot. So you've got this list, you've got 50 villains. And like I said, I love this concept because it actually, when you get into trying to analyze the financial crisis, it's always about policy and about, you know, this policy and that policy and this move and that move, and you kind of personalize it by focusing on some of these personalities. So I don't want to give away everything on the website because we want people to visit, but I'm sure people are curious. Can you just kind of give us an overview of maybe, like, in your mind, you got the top three? Who are your top three villains?
Sure. Well, what I call them on the website are dunces. I lived in New Orleans, or just outside New Orleans, for a couple of years, and there's a very famous book about New Orleans called The Confederacy of Dunces. And so I was inspired by that title to come up with this list. It's There's definitely Greenspan, Lawrence Summers, in his role in really blowing up the derivatives market. Bill Clinton, because he really got the ball rolling he had a plan to increase home ownership to 67.5%, which was a huge increase from where it had been. And then that decision prompted all sorts of changes to Fannie Mae and Freddie Mac and mortgage rules. So he's there. I put Andrew Cuomo there, who was one of President Clinton's housing secretaries, and certainly Bernanke.
Yeah, absolutely. I knew that name would come up, and we'll get to him in just a minute. Um, so give us somebody that's on the list that maybe people might not think of, that you kind of find their role in all of this particularly interesting. One of the off the wall people, maybe.
Sure, sure. There's this guy named William Apgar, and well, let me think. Yeah, he's a good one, and he's a Harvard PhD economist, and he was supposed to be an expert in housing. I mean, that's what he considers himself. And when Andrew Cuomo was housing secretary, Apgar was Cuomo's like lieutenant. And what Cuomo did, and this would have been in October 2000, there was something called the Affordable Housing Mandate for Fannie Mae and Freddie Mac. And what he did was he required Fannie and Freddie for 50% of their mortgages to go to low and moderate income borrowers. And before President Clinton had started his housing, strategy, is what he called it, that number was about 30%. So the only way to issue mortgages to, all these people that would have not been able to get them before was to just wreak havoc with the lending standards, which of course is exactly what happened. And so, this Apgar guy, he was just like a functionary, you know what I mean? But that's what you need to do this. I mean, you had Andrew Cuomo out front pushing all this stuff, but the real man behind the curtain was William Apgar. And there's people like him all over this list, that are kind of obscure, but that really, really had a major, major impact in what happened.
So how did you come up with this list? I mean, that must have you must have done quite a bit of research to come up with 50 people, especially somebody like Apgar. I mean, that's not like he hears, it's not like he hears his name on CNN every night. What
Sure.
was kind of the process that you went through research wise to come up with this list and really, I guess even more than that, to have a broad understanding of how all of this unfolded?
Well, I actually have a draft of a book that I'm trying to get published. And what I heard, well, to get your book published, you really need to have a website. If you're not a famous person and everything else, and you use the website to drum up interest. So basically, I distilled a lot of information from the draft of my book and put that onto the website. And that's it was largely from the draft of my book that I got the Confederacy of Dunces.
That makes sense. So you've kind of taken broad-based research and then distilled it down website form and so people can kind of take it in chunks.
Yes, yes, and then that's exactly right. And the other thing that you can get on the website is there's a whole timeline of the financial crisis, which again was pretty much distilled from the book.
So playing devil's advocate, all this is cool history and whatnot, but that was 10 years ago. What are the lessons that we can take from the 2008 crisis and the ramp up to it and apply it to today? I mean, what does your average guy care at this point how the financial crisis unfolded?
Well, it was one of the things that I talked about in the book was when because it really started, and I don't mean to, and I try not to be political in the book because as soon as you mention politics, people kind of lose their minds. But where it really started was when President Clinton set this goal to increase home ownership. And you think, well, what's wrong with that? That makes perfect sense. But the point, and I contrasted that with when he did that, that was a couple years after the Soviet Union collapsed. And I was like, Soviet Union, they gave central planning a pretty good, effort at making it work, and they weren't able to. And I said it was pretty ironic that a couple years after that example, we went off on our own central planning exercise that created more losses than anyone that the Soviets ever tried. And that's really what it was. It was a central plan. And that's really what the Fed does. The Fed is not a bunch of central bankers. They're central planners. And when you look back at like the Bank of England, the Bank of England was always passive, until the Great Depression. And they had an operating rule that said, they'll lend freely in a crisis, but only against good collateral and only against high rates of interest. And so the point was it was basically real bills and in other words, the central bank only reacted to what was going on in the economy. They didn't try to force it in any particular direction. And the whole notion of the Federal Reserve, it is so far removed, from what the original concept was. So, to me, that would be, I mean, politicians are always going to be politicians. They're always going to do silly things. But it's when the central bankers create money that, gives them the wherewithal to do all these funny things that things get really out of control. Because, I mean, when the housing bubble was blowing up, the savings rate in the US was non existent. So much of the credit that fueled the housing bubble was all a consequence of the Fed intervening into the economy after the tech bubble collapsed. So, going forward, that's really the thing. The whole notion that the Fed is this man in a cape that can, get some desired outcome from the economy, it's just wrong. And it's been proven wrong time and time again.
So there's kind of two sides to the equation when you look at the way the financial crisis unfolded. And you have the government policy, which I'm not particularly savvy on. You obviously know a lot more about that, the nuts and bolts of this drive to create affordable housing. And on the other side of it, you have the monetary policy, which is the artificially low interest rates, the money printing that creates the ability to manufacture the debt to back up these bubbles. And we've certainly seen the Federal Reserve double down since the 2008 crisis. I mean, we were at 0% for what, 7 years or something
Hmm.
absurd like that. And now they're starting to try to quote unquote normalize, but we're still only at 2% in terms of the federal funds rate. So you look at the economy today, I don't think that, I mean, we do have a housing bubble to some degree, but I'm not sure that that's where the big bubble is. Uh, I think there's a lot of them. Do you have any sense of where they've blown up the bubble this time around? I mean, there's a lot of candidates, I guess. You've got an automobile bubble, you've got a student loan bubble, you've got a stock market bubble, uh, a bond bubble. Is there any particular area that you see at this point that might be particularly worrisome?
I would certainly be in government debt. I mean, you think about, first of all, I mean, like the Fed has a goal of 2% inflation, which is a completely ludicrous goal, to have a desired rate of inflation. But here they are with this goal of 2%. And, until recently, that's about what the 10-year treasury bond was, yielding. And the people that are buying those bonds at that rate, they don't plan on cutting coupons for the next 10 years. It was all a arbitrage and trading positions. And if rates really start going up, and I'm not sure if they can with the amount of interest we'd have to pay on all our debt, but if rates really went up, I mean, there'd be tons of sellers and there wouldn't be any buyers, and that's certainly what I see. And I mean, again, not to make it political, it just happened when he was president, and I don't think it would have been any different under a Republican. But I mean, it took us 200 years or whatever to get 10 trillion in debt, and that was equaled in 8 years when Obama was president. And it's like, well, that can't go on. I mean, just that's impossible. Can't be done.
Yeah, absolutely. And Trump certainly hasn't slowed the roll at all. I mean, we've seen, we've already raised the debt ceiling and added another, I think it was 313 billion in just temporary spending. So I don't think the Republicans in Congress are any more interested in actually cutting spending and dealing with the debt. It's interesting you mentioned the interest rates and the payments that you have to make on the debt itself. I did an article for the SchiffGold website not too long ago that within the next 30 years, the outlays simply to service the debt on this 21 trillion, which is going to be more than that once we get to that point. But it's actually going to be equivalent to what we're outlaying for Social Security. So we're going to be spending just as much money paying interest on debt as we are on Social Security within the next 30 years at the current rate. And that's CBO numbers, and the CBOs is not exactly liberal with its parameters. It tends to be pretty conservative. So that's pretty disturbing. And that's, Peter Schiff talks a lot about whether or not the Fed is going to be able to actually normalize. I mean, 2% anywhere near normal. And I tend to agree with Peter that there's really no way that they're going to be able to truly normalize in this environment. Not only the government debt, but it also impacts corporate debt and household debt. I mean, household debt's at a record high right now too. So, you've got this huge debt bubble in all of these different areas. So I think you're right on target with this debt situation. You wrote a really interesting couple of articles that we published on the SchiffGold website about Bernanke and his theory on the Great Depression. And I'll link to those in the show notes page. But I think it'd be kind of interesting to give a little overview, because I really think that you, in those two articles, kind of summed up the problem with all of this financial planning, and you kind of dug into the hubris that we see and why this is really a problem. Can you just give us a kind of a quick overview of those two articles?
Sure. I mean, one, I actually, there was a Far Side cartoon from way back in the 80s, and it talking about a girl who's studying to be a veterinarian, and she's studying, the chapter on horses, And of course, for every malady that a horse can have, the solution is to shoot the horse. And the cartoon says, well, of course Doreen breezed through chapter 9. And that's, I mean, it's funny and everybody laughs, but that's basically how Ben Bernanke looks at the economy, except it's not shooting the horse, it's increasing the money supply. And for him, that's always the panacea. And that's just not the way the world works. And it's on that basis that he, in my opinion, completely misanalyzes, the Great Depression. And he mentioned this in his book on the crisis, The Courage to Act, where he credited Roosevelt for trying all these different things to spark a recovery. And he said, well, that was good. That's to Roosevelt's credit. And to anybody that's ever worked in a private company, the worst thing for a private company is uncertainty. And when Roosevelt was trying all those things, it just wreaked havoc, and that forced everybody to batten down the hatches. And he's just Bernanke in particular is just so far removed from how things actually work, and he just gets lost in his academics and his formulas and everything else, and it's reflected in his analysis of the Great Depression. That he completely misses the human factors. Like when Great Britain got off of gold, that was a huge shock. That was an amazing shock that all over the world, was this great economic shock that was negative in all sorts of aspects. And Bernanke looks at that and is like, well, that was the perfect thing. That was the right move, because now they're free to increase the money supply and do all this other stuff. And in the one article in particular, I talk about how his theory is completely contradicted by what's happened to the average working person. Their incomes have increased tremendously in dollar terms, but in terms of what they buy, they're a fraction of what they were 40 or 50 years ago.
Yeah, absolutely. And I think that's where, most people watching this, we all know, I mean, we all see it in our own budgets and our own lives. You look back, just 30 or 40 years ago, a single earner in a family could very easily support a family of 4 or 5 people. And it's virtually impossible now without dual incomes to make it. So, and what enrages me is that all of this is on purpose. You talk about the 2% inflation. They're intentionally debasing our currency and intentionally destroying the value and the purchasing power of our dollar. And they try to frame it, oh, this is a great policy, and this is our 2%. Oh, it just absolutely makes me crazy. So,
in the little Dunce biography of Charles Evans, who's I think he's right now on the FOMC. He's a voting member, and he's historically been considered an inflation dove. He's definitely on the soft money side of things. And in that little bio, there's a quote attributed to this guy from way back in the 1800s, and he called inflation the surest way to fertilize the rich man's field with the sweat of the poor man's brow. And everybody talks about wealth inequality and all this other stuff. It's all fueled from, the monetary policy that we get from the Federal Reserve, because all that money goes into the financial classes and the financial assets. And, there's the vast majority of people in this country, their financial holdings are very, very small and humble.
yeah, absolutely. And, I can see it just in, we did an article, oh, it's been a couple of years ago now, about the minimum wage. And there's this, the push for the $15 minimum wage. And we're going to use, again, central planning and politics to dictate wages. But it's interesting, if you look at the minimum wage in 1964, when we still had silver in our currency, so quarters, dimes, and nickels were made out of silver. The minimum wage was $5 silver quarters. So it was $1.25 an hour, if I'm remembering the numbers correctly. If you take the melt value of those quarters today at the current price of silver, you get about $15. So,
Yeah.
there's your $15 an hour minimum wage right there. And that's how much just since 1964 that the central bankers have debased the currency. So,
Yeah, and you were mentioning the articles that I wrote for the SchiffGold website. There is one where I basically normalized everything based on the price of gold,
right.
and that's exactly what you see, is that the incomes have soared in dollar terms, but they've fallen tremendously in terms of course, ounces of gold, but in terms of what they can buy, whether it's cars or milk or weed or anything else.
It's also interesting to look at the value of the stock market when you convert it to gold.
Yeah.
Uh, there was an article that I believe one of the SchiffGold precious metal specialists wrote it, if I'm remembering correctly, and I'll try to find that chart and I'll put it here in the video. But it shows how big the peaks and valleys are in the stock market. We tend to think the stock market progressively goes up, but you see much more of the volatility when you convert it to reading it in terms of gold. So here I've got a question for you. We're gonna speculate a little bit. I think you and I would both be pretty comfortable saying that we're heading for another crash in the relatively near future. Obviously, we can't predict uh, the how or what, or we can certainly have some good ideas, but I think we could probably agree that we're on an unsustainable path. There are a lot of bubbles. Something's going to pop. We're at the peak of the business cycle. We're seeing that interest rate push up. I've seen some pretty good economists speculate that probably once it gets to maybe 3.5%, that's going to be the tipping point. We're going to go back into recession. So we've got a new chair. We've got Jerome Powell, who, in my view, is pretty much cut from the same cloth as these other guys. But if you just had to go out on a limb and predict, how do you think he's going to react to the next crisis? Do you think he's going to follow the Bernanke, Yellen, uh, and crank down the interest rates and go into quantitative easing, or do you think he might try to suck it up and hold the line and let things correct?
It's hard to say. I don't have any great insight into him, but the one thing is that's different than him from Yellen or Greenspan or Bernanke is I think he's a lawyer by trade. And he's not a PhD. I'm almost certain he's not a PhD economist. And so he may take a different tact. Certainly the Federal Reserve as an institution, there's a tremendous amount of inertia within the Fed to do exactly what you described. And I certainly don't know if he's strong enough of a personality to get them to do something different. It's hard to say. I think there'll just be so much pressure, and the consensus is that everything that the right reaction is to cut rates and do all these things they've done in the past, which of course never worked. So I'd be surprised if he didn't, but I'm hopeful, like I said, because of his background, maybe there's enough of an iconoclast in him to do something different.
Yeah, I mean, you'd think at some point they would look and say, "Well, we've tried this twice. Well, we've really tried it more than twice, but we've tried it twice, big time, since the 1990s, and we've ended up with it would be the third big disaster." You would think that they would look and you know look at what Einstein, like they attributed to Einstein. I'm not sure that he really said it, but the whole idea of insanity is repeating the same thing over and over again and expecting a different result. But I'm kind of with you. I feel like the momentum of the institution, and it's not just in the United States. Of course, you've got the European Central Bank, you've got the Bank of Japan, you've got the IMF. I mean, they all pretty much read out of the same textbook. They're all reading out of chapter 9. So I'm not real confident, but Peter Schiff's been talking about this some, and his view is that it's in all likelihood they'll try to double down and reinflate the bubbles. But he feels like the next crisis is going to be a dollar crisis, and we're going to have the inflationary pressures, the true inflationary pressures, are finally going to catch up because you know people say, well, we don't really have that much inflation, but it's because they're misdefining inflation. Inflation is actually just an increase in the money supply, and that's increased dramatically over the last decade, even though we haven't necessarily seen it in consumer prices in the way the government measures it at any rate. So Peter feels like that inflation pressure is going to catch up, and we could end up in a stagflation situation like we saw in the 70s. And
Mhm.
then you kind of do put the Fed between a rock and a hard place. Do you treat the inflation, or do you try to save the dollar? Which way do you go? So it'll be interesting to see how it all plays out. Um, Kind of want to wrap up on just a quick thoughts from you on gold. This is a podcast about gold, so we kind of
Sure.
be remiss if we didn't talk about gold. How do you view gold just as an investor and in your own portfolio and your own investment strategy? How does gold fit into that? And maybe if you have any idea, you may not, but where you see gold going in the next couple of years. I think a lot of people are kind of bearish on the gold and silver both right now because we've seen the price drop quite a bit in the last 2 or 3 months as the dollar's kind of strengthened. But what's your thoughts on gold?
Yeah. I mean, as an investment, I mean, it's you know what I mean. If you think about what gold's function was and why it was money, it was a store of value, and it still works in that regard very, very well today. It certainly can be volatile. I mean, we know it was 1900 and it's 1200, but if you go back to 1971 when Nixon closed the gold window, it was $35. And so it's gone up whatever 35 times since then, which isn't bad, and so like I said, from that standpoint, I think it's invaluable. And then certainly history shows us that there are times when it's been a tremendous investment, where it's been able to generate huge returns. Even if you go back to the year 2000, and here we are at 2018, I'm sure gold is a much better investment than the Nasdaq. The Nasdaq was at 5,000 in the year 2000, and it's gone up, let's say 50% since then. Gold was $250, $300 an ounce back then, and it's at 1,200 now. So, but I do think for all the reasons you said about all the different central banks reading from Chapter 9, um, there's certainly the conditions out there that could cause a substantial increase in the price of gold. But exactly when it is and what sparks it, that's very hard to predict. Um, but it's money par excellence, and still is that.
Absolutely. And I tend to think that what we have right now is a buying opportunity, really, because the price has dropped pretty significantly. I think 4 or 5% in the last couple of months, and we've got some dollar strength. I just don't really see that lasting, and even some of the mainstream economists are saying, this is kind of a blip on the radar as far as the dollar goes. Peter says what we've got right now is a dollar rally uh, in a bear market, so a bear market rally, and I tend to agree with that take. But I think regardless, over the long term, I've done some writing over the last few weeks on just basic fundamental supply and demand. Overall, the gold demand is looking to be strengthening for a variety of reasons. The supply of gold is certainly under some constraint right now. There are issues with mining production. There are some people that are even arguing that we might be close to peak gold.
Mhm.
It's getting more difficult to mine. And so I think just looking at the fundamentals, as a long-term investment, as you say, a store of value, it's just like the silver quarters we talked about. If you have a silver quarter from 1964, you don't want to go put that in a bubblegum machine. Uh, so, just looking at that long term, I think that's right. Well, I really enjoyed this conversation. It's kind of different than any of the interviews we've done, and it's. I think a lot of people are interested in how this whole Federal Reserve thing works, and I think a lot of people aren't really nearly as familiar with it as they need to be. People tend to focus on the politics and what the tax policy is and what the president's done, and that's certainly important and plays a role. But the Federal Reserve, the monetary policy is certainly one of the biggest drivers of the economy, and you do a great job of dissecting that on your website. Why don't you take a second and give everybody all of your vital contacts? Where can we find Peter Schmidt?
The best place to go is to go to the 92ers.com website. You can link to my Twitter account there. I'm not huge on social media. I have to do a better job of that. But the website will take you to my Twitter account, which is at the 92ers. Those are definitely the two best places to go.
And I'll vouch for the website. If people should definitely check it out. There's a lot of great information. It's very well done, very professional, and I think people will get a lot of very useful information out of it. And hopefully you'll get that book published, because I would love to see the arguments fleshed out and kind of go undermine the typical narrative that we get, that it was because of deregulation and greedy rich people.
Well, thanks for the opportunity. I really, really appreciate the opportunity to speak with you and all your listeners. I'm really, really appreciate it.
Absolutely. Well, thank you again, and you enjoy the rest of your evening.
You do the same, Mike.
You've been watching It's Your Dime, an interview series presented by SchiffGold. For more information on investing in gold and silver, talk to a SchiffGold precious metal specialist today at 1-888-GOLD-160. That's 1-888-465-3160. Or visit us on the web at SchiffGold.com. You can keep up with all of the latest precious metals news at SchiffGold.com/news, and tune in each week to the SchiffGold Friday Gold Wrap podcast. This is your host, Mike Meharry. I appreciate you watching, and I'll talk to you again next time.